Did you know that some of the world's best performing stocks are often overlooked by the majority of investors? The market can sometimes offer hidden gems, undervalued stocks that, with a little patience and insight, can turn into major long-term wins. But how do you spot them? And more importantly, how do you hold on to them for the long haul? Let's dive into that today on Factful Finance. Before we get started, a quick disclaimer. The information we're discussing today is for educational purposes only. I encourage you to consult a professional for personalized guidance. The apps, products, and services mentioned are not endorsements, just tools to consider in your financial journey. Now, let's talk about undervalued stocks for the long term. This is one of those topics that can be packed with jargon, so I'm here to break it down in a way that's both insightful and actionable. Whether you're just getting started or have been in the market for a while, understanding undervalued stocks is a critical component of successful long-term investing. At its core, an undervalued stock is one that is trading for less than its intrinsic value. Think of it like buying a designer handbag at a garage sale. If you know the true worth of that item, you're getting a bargain. In the stock market, this happens when a company's stock price is lower than what analysts believe the company is worth based on fundamentals like earnings, growth potential, and industry position. One way to identify undervalued stocks is by looking at the price-to-earnings (PE) ratio. The PE ratio is a simple way of comparing a company's stock price to its earnings per share. Generally, a low PE ratio might indicate a stock is undervalued. But there's a catch. Some sectors naturally have lower PE ratios than others, so context is key. For example, tech stocks tend to have higher PE ratios than utility stocks, so a low PE in the tech sector might not be the same as a low PE in, say, the energy sector. Let's consider a real-world example. Meet Liam, a 32-year-old engineer who decided to take a closer look at the stock market. He'd been hearing about a company, Let's Build Tech, which was in a rough patch. Its stock price had been dropping for months. Liam noticed that the company's PE ratio was 10, well below the average of 20 for its industry. It seemed like a red flag. But after looking deeper, Liam realized that Let's Build Tech had strong fundamentals, a new product line on the horizon, and a loyal customer base that could drive future growth. He decided to invest, holding on through the volatility. Fast forward 5 years, and Let's Build Tech stock had tripled as its new products hit the market. Of course, buying undervalued stocks isn't a foolproof strategy. It's important to consider the why behind the undervaluation. Is the company undervalued because it's struggling with management issues, or is it simply being overlooked by the market for reasons unrelated to its true value? Benjamin, a 45-year-old investor with a diversified portfolio, made a similar move a few years ago with a pharmaceutical company, HealthMend. HealthMend's stock was underpriced due to a short-term setback in its drug pipeline. However, Benjamin believed in the company's long-term potential, especially with its research into cutting-edge treatments for chronic conditions. Today, HealthMend is a staple in Benjamin's portfolio, delivering steady returns year after year. Here's where long-term investing shines. Patience. Undervalued stocks can take years to rebound, but if you choose wisely, they often reward you for sticking with them. The key is to focus on companies with strong fundamentals, solid leadership, and a clear path to growth. Now, if you're wondering how to manage these stocks in your portfolio, diversification is your best friend. You don't want to load up entirely on undervalued stocks, especially if you're early in your investing journey. Instead, create a balanced portfolio that includes a mix of asset classes, stocks, bonds, maybe even some real estate or commodities. This way, you're not putting all your eggs in one basket, and the risk of holding undervalued stocks is mitigated by other investments. For instance, Olivia, a young professional with a steady job, followed the principle of diversification when she invested in undervalued tech stocks and some steady blue-chip companies. When the tech market took a dip, her blue-chip stocks helped smooth out the ride, ensuring that she wasn't overly exposed to risk. If you're thinking about getting started with undervalued stocks, tools like stock screeners can be invaluable. These platforms let you filter companies based on criteria like PE ratio, dividend yield, and more. Websites like Morningstar or Seeking Alpha allow you to research stock fundamentals, while brokers like Fidelity or Charles Schwab offer analysis tools to help identify undervalued opportunities. Let's wrap things up. Undervalued stocks can be an excellent way to build long-term wealth, but they require research, patience, and a willingness to hold through market fluctuations. Just remember to check for strong fundamentals, take a diversified approach, and keep an eye on the broader market trends. What's the first step you'll take toward identifying undervalued stocks for your long-term portfolio? Share your thoughts in the comments. We'd love to hear your strategies. If you found this video helpful, why not hit the like button and subscribe so you don't miss out on more insights that can power your financial journey. Also, be sure to click the bell so you're notified whenever we release new content designed to keep you on top of your game. We think you'll find the video shown next really interesting and helpful for your financial goals. Thank you so much for tuning in today to Factful Finance. Here's to making smarter financial decisions and building a better tomorrow.